Oh, we are live. Okay, I think we are set up, Ron.
Yes.
So first of all, welcome everyone. This is our second week. The Collaborative Network team trying to put together some resources for the small businesses out there. We decided to put a focus on the small business of the restaurant industry. Um, we're picking up where we left off last week. We had a guest named Martin with Maria's Cafe in Colton, California. Ron had provided a lot of great information. We uploaded that video, a short version of it, on YouTube, on the Collaborative Network's YouTube channel. It's also on the Facebook group if you find it through the comments, through the Collaborative Network page, posted that video. Today, I asked Ron if he can join us again. I didn't bring Martin in today to the panel, but I did want to see if Ron can go in depth on this breakpoint even analysis and potentially breaking down the expense categories. I know that you mentioned last time there was 4 type of categories of expense of income and expenses and 2 variations of it. So I wanted to see if we can break that down. So for anybody that's trying to do this at home eventually to try to figure out when they're going to be profitable, they have the ability to potentially do it themselves, or we can use this video as a resource. But yeah, that's kind of what I wanted to focus on today. And hopefully next week we can have actual live numbers from a real restaurant that we can plug in, and hopefully the audience, whoever's a restaurant out there or similar business model, could use this information to know when they're going to make money, how many clients, or potentially change their strategy on how they're going to go about their business. So with that said, again, Edgar Martin, I'm with the Collaborative Networks, and with me today I have Ron.
Thanks. Brief introduction. I have been in business for a really long time as a manager and an owner. I've started 6 businesses over the years. I've been in consulting for 3 decades, working with small businesses, and come up with a few tools over the years that I found were not typical. They're not the things I learned in business school those many years ago. They're not the things that you find in accounting books very often, or they're applied to totally different functions, such as, say, manufacturing, break even for machines and that sort of thing. But what I've found is they've been very useful. They've been in practice for many years, and I found them to be very useful tools. And usually they're tools that people have not heard about before, and they're not terribly complicated. I'm going to try and walk through these. This would be a little bit detail oriented, more class-like maybe than our interview last week. But we want to give you enough information so you kind of get the concept and you can mess around with some of these things on your own, or come back to this and see how we do it, or we can provide you with a basic spreadsheet and mess. That way you can just plug in the numbers. So we want to go through 2 or 3 things today. And talk about the real important issues of cash flow, and then another second one in terms of break even. I'm going to walk you through a couple of slides, and then we'll actually show you some numbers and how things work live if we change scenarios. So that's where we'll go. Last week we started with this little graphic, and we'll just kind of walk through it briefly. We want to explain what cash flow is, as opposed to other kinds of reports. Typically, from your accountant, you receive an income statement or statements. The income statement is, as it says, it basically calculates whether or not you have any gross profit at the end of a particular period. You'll typically also have a balance sheet on there that is really a summary of what your assets and your liabilities are. So those are the 2 ways that most CPAs like to look at things, as the way bookkeepers prepare things. But there are several kinds of accounting. That tends to be what we call financial accounting. It's used primarily for taxes. And so because CPAs are interested in taxes, that's what they're interested in providing. And then they'll do your taxes based on those numbers, which follow, ACPI rules, etc. But there are other reports, really called management reports, that many times will give you they're better tools for certain things. It's very difficult, for instance, to know what cash flow when you run out of cash based on an income statement. As a matter of fact, a lot of times they only touch just a little teeny bit, and that is, well, did you have profit for a period, and is it in the bank? But during that point in time, for all 30 days maybe, you'll find that the balance in your bucket goes up and goes down. And that depends on how many faucets you've got open, how much money is coming in through the faucets, and how many expenses or holes you have in your bucket. So they come from a couple of places. First, cash sales. When cash comes in the front door, rarely comes in the mail anymore, but you might count electronic funds transfer as cash. As that comes into your account, that's one source. And then you also have your accounts receivable. That also comes into your account in the form of a check, etc. But it sits on your books as an asset until somebody pays their bill. So in other words, you can have a sale, and it could be a cash sale, or it could be an account sale, meaning it is going on your customer's account, but you didn't get any cash. In a financial statement or in an income statement, they both show up as sales, but you can clearly see we've already discovered two kinds of sales. Then you can also have loan proceeds. That's a big topic right now, and one of the reasons that we're having this conversation is because of the PPP programs, and of course the other SBA programs. Then there'll be a lot more discussion about that as this series goes on. Loan proceeds comes into the business as a form of cash once it's been funded, and so obviously it's another source of cash, but it's not sales. Then you have an asset sale. You can just take something and sell it. It could be used office equipment or a machine, a car, maybe a building, and that can come into the business as cash. Owner investment, that happens quite a bit in small business, where you may just make a loan to yourself as the owner into the business, that is, and so that's a source of cash. That happens in small business really quite a bit. Then you've got the bank bucket, and the bucket itself holds the water. So as the drips or the water flows down the trough here in, as they hit these holes, they begin to come out in the form of expenses. And so you've got all of these other things coming out of your checking account, what you pay for your inventory or your raw materials, regular business expenses, of course, taxes. It's a big number. You can't forget about that. Any loan payments that you make, it really takes cash. That's treated differently on the income statement because only the expense of the interest is actually an expense on your income statement. But in this particular case, a loan payment does take cash away from your bucket. So that counts. Asset purchases, just like you can sell something, you can also buy something, and that takes cash, maybe a down payment, maybe partially a loan and a down payment. And then what's left ends up as the owner's draw, balance in the bucket, you can leave it in the bucket. You can take it out as dividends in large companies. So those are kind of the things that you use that for. So what we want to talk about now is a concept of break even. Oh, by the way, this represents the balance in your bucket. Thought there's a nice effect there. So what we want to do here is just introduce you to a break even. Now, a break even is a little bit like a income statement, but in this particular case, we want to look at the different kinds of expenses. An income statement does break expenses into different pieces, usually very detailed pieces. Sometimes the cost of goods sold is broken out as a separate group of expenses to go against your sales. So you might have an income statement that says sales or revenue, and underneath that would be the cost of goods sold. And then maybe your your margin, your gross margin, we call that. And then your expenses are subtracted from your gross margin. But that still doesn't take into account the nature of the expense. So I wanted to talk a little bit about that, and it's fairly simple. It has to do with fixed costs, those things that you have to pay just to open your business every morning. It's kind of a simple way to remember that. Rent is the big one. And then, of course, if you have salaried people who come in and get paid whether they work or not, or they may be there, maybe they're working, but they may or may not be producing anything. And so that's a very big fixed expense. And then you have variable expenses. Sometimes they're called direct expenses. Those are expenses that are different in the sense that they literally go up or down based on whether or not your revenue goes up or down. One of the really big expenses there, which is really easy to understand, would be salesperson expense. So if you're paying, 5–10% of your revenue as a sales commission to a salesperson, that is a variable cost that not because it varies up and down, but because it varies with the amount of the sale. It's a direct expense in that you sell something for $100. If you're paying 10%, the cost is $10. So that is a variable cost. And then, of course, you have to look at both of those together. Now, all of those expenses are either controllable or not controllable. Typically, every expense is controllable at one point. And it's usually when you take it on. You can't control rent very easily after you signed the contract, the lease, but you do make a decision to sign the lease. That's when you've taken that expense on. That's not true of a variable cost, as we mentioned, and that is that now you're only paying based on whether or not your sales go up or go down. There's a little bit more to it, but those are the basic 4 functions. So what I want to do here is just illustrate how a break-even looks if you chart it. So this is a pretty typical chart. At the left side, we have expenses in dollars, and they go from 0 perhaps up to infinity, but hundreds of thousands or millions of dollars. So as this goes up, the expense gets higher. Across the bottom, we have a dollar value, volume. And that means that on this side, you have a low dollar volume, on this side, a high dollar volume in terms of revenue. So that's revenue dollars. So as we go up, we have expenses that will be going up and falling, and we have more and more volume going this way. So the first expense we need to understand is what we call the fixed expense. That's a straight line. And the reason it is typically, this is not, there are always some exceptions, but typically the reason is that the fixed expenses are going to be a certain dollar amount, maybe every month, maybe every year. That doesn't mean that they don't go up and go down. Your gas bill goes up and down with the temperature, say, or with how much gas you're using. If you're a steel manufacturer, you're using a lot more gas, and in that particular case, the more gas you use, the more steel you make. So that's actually a variable expense. But for the most of us, gas, utilities, electricity, it takes a certain amount, and it may go up and down based on air conditioning, but for the most part, every year it's going to be a pretty flat expense on an annual basis, even though it goes up and down monthly. So we represent that as sort of a flat expense. If you wanted to get really detailed, you could chart this, and it might go up or down a little bit with sales volume, but that's sort of like level 2 of this discussion. So right here is your break-even point. Your revenue goes up to a certain point. That's now enough money to pay for your fixed costs. And from here on out, this space here represents profit. The only problem with that is that it doesn't work that way very often. For the most part, you have another set of expenses. Those are the variable expenses. So every time you sell $1, you have a commensurate part of $1 that goes to something else. So if you sell, $10 here, you might have spent $6 to buy all of the raw materials to make the product. Or you might, if you're buying and reselling, you might have spent $6 to buy it, and then you mark it up and mark it down. And so that is a variable cost. That's could be your cost of goods sold. Includes commissions, and then there are other variety of expenses that can be part of your variable costs. Together, the fixed cost here and the variable cost here end up creating your total costs. This arrow represents the fact that it's normally a constant percentage as it goes up. But again, that's not always true. Sometimes as you have things go up bigger and bigger and bigger in terms of sales, you have expenses that begin to decline as a percentage because you're making more of a product and you're gaining efficiency. So sometimes this can be a curved line that makes the calculation a little bit more interesting, but nonetheless, we still end up with a nice break even. So what happens is if we take this line and we add it to the fixed expenses, you end up with a new line. And in fact, this is your real break even point. So as you add your fixed and your variable expenses together over volume, you now have the equivalent of profit here. So you can see the characteristics of how these expenses work. And characteristically, you end up making a little sliver of pie as your revenue goes up and as your expenses, your variable expenses go up, and as your fixed expenses stay generally the same. Now, there are those who argue that fixed expenses don't stay the same, that they go up every year, and that's generally true. But at the end of the year, that's a little jog. You come along, as the end of the year, it pops up, now it's higher. Or this whole line just pops up a little bit, and now you have a new cost structure. If you said, well, we'd like to look at next year too, and we know this isn't right, you would take the red line and pop it up, the blue line would pop up, and then over here would be your break even. And so the difference from where you are now to where you're going to go ends up being your new break even point. Well, the important part of knowing your break even point is literally, that is the exact point at which all of the margin from the sale of goods, your gross margin, are equal in dollars to your fixed costs. So variable expenses are always expressed as a percentage. Fixed costs are always expressed as in dollars. In that way that we can calculate, it's not easy to do, and to try and deal with both percentage and fixed. And so what happens is we end up building these big long spreadsheets, which is all fine too. But what this gives you is an opportunity to know exactly where you break even, and then it helps you understand where you have to go. So if you had a particular goal, for instance, of you wanted to get to, say, this margin, then that tells you you've got to go this far up to this dollar amount in order to create that much profit. And it's easy to do. There are other applications as well. Many times you have to think on the fly. For those kind of companies that sell big projects in construction or equipment, and you're negotiating with someone, or you're creating bids, many times you can negotiate based on the volume of their expenditure. So you need to know what your break-even point is for a particular project. And so this can take into effect all your fixed expenses allocated properly against the project. And then you add your variable expenses, and that can tell you exactly when you begin to make money. Very, very few companies, especially small companies, do this. The vast majority of them use standard rates, standard markups, and then they wait a month, 2 months, 3 months and see if they made any money. You can do this with project costing. It's a lot more involved to do at that level. Construction companies do this quite well. But you have to properly allocate your fixed expenses. to a new volume level, because many times your volume will double or go up 20%. And so what happens is that the apportioned amount of the fixed costs goes down for the project. Well, when that goes down, that means your price can come down and you can still make X amount of dollars. So having this understanding your margin as a percentage can very quickly help you understand when you start making money on a particular project. And when you're playing scenarios with overall dollar volume against your expenses, it's very useful. This is particularly useful in marketing and sales for the reason that I just mentioned. So that's the very basic concept of how that works. So
if you don't mind going to the graph that shows the bucket situation, when I've seen people take accounts receivables and turn them into almost advances by taking the percentages by using factoring companies, right? In other words, figured a way how to take a cut in the top end of it, but having their money deposited there quicker. But I don't really necessarily think in this scenario, if you're going to be using a restaurant as an example, they're really going to have that many accounts receivables. Everything's going to be paid on delivery. So
probably not. Catering might be the exception there, but you're probably not. Yes.
But I did want to kind of throw that out there. But in a restaurant that is running, on these cases, I think most of their revenue is either coming from cash or people paying on there. So
Yeah.
it would be a lot easier when it comes to restaurants to measure the breakpoint even analysis, I believe, than typically like a manufacturing facility or a more complex business. Or is there anything else that they should be worried about measuring, maybe on the other end of things, for example, the vendors, like the vendors themselves?
No, you're quite right. You may get some credit from your vendors. In the food business, it's not very much or not very long. For the most part, 10 days would be kind of about it. They pretty much expect you to pay right away. And the reason for that is that the food distributors, have to pay their bills pretty fast. There's not a lot of float in that kind of industry.
My name is Esteban Gonzalez. I own an auto repair shop in Colton. I opened it in 2014.
I'll throw in a comment for your industry, though, Esteban. You're dealing with parts that you have an absolute cost on, and so that's easy to figure out. But in addition to a part, you've got a whole bunch of parts maybe. And so now you have to add them all together in order to figure out what your cost is for a particular project. And so those are variable costs, because you're taking a certain markup. You probably rarely change your markup on your parts, but you might, and you might need that in order to know whether or not to negotiate. Then on the other hand, you've got labor, and a lot of times you charge so much per hour for labor, and that's just fine. But in that particular case, the labor is variable, because you wouldn't be doing the work. The direct labor for the repair is variable. You wouldn't be spending the labor unless you did the work. Now, here's the caveat, and this is when I say there's sort of like another function. We won't get in too far here, but the caveat is you might have a mechanic come to work, and if you don't have any work for him, you're paying him anyway. Well, at that moment, his particular salary, that portion of his salary, just switched over to a fixed cost. And so for the many shops, they would take their labor and they would treat that as a fixed cost, even though you're in the manufacturing or fabrication business that could look at it in a couple of ways. So.
Thank you for that. That made a lot of sense. Thank you for that. That made a lot of sense.
Another thing you mentioned, managed reporting. It's a difference versus going with the CPA, right? Often that was, I think, one of the missing pieces to understand the actual inner workings of a business. I wanted to see if you could touch bases on, we spoke about this before, on how much is too much reporting, or when am I reporting too much? Because I know when I used to talk to CPAs in a business that we have in Mexico, this guy didn't want to do anything. He just give me the information for taxes. I'm not going to go down and break down how many burritos you sell, or how many tacos you sell, or how many things you sell. We don't want to know that. We just want to know the bottom line.
Yeah, what you mentioned is really typical in my experience, and I've had I think seven or eight large accounting firms as clients, CPA firms as clients. So I've been on the inside of their world. Meanwhile, I've had hundreds of clients over the years, of dozens of whom I actually worked with their CPAs. So I have a really extensive experience in dealing with this. And I would say that 80 to 90% of the time, what you state is exactly right. You may get someone to give you, a payroll report or help you with costing, but that tends to be unusual. Now, the reason for that is that those are one-off reports. They don't just spit out of the computer. They're used to being able to have the bookkeeping department, your bookkeeping department, prepare your files, and then you just send your files over to them. Or in the old days, they had their people many times input the stuff for you. So as long as you selected the right account and you understood debits and credits, then all you have to do is just put in the time period, and it's for a month or a quarter or a year, and it spits out the statement pretty accurately most of the time. Well, doing reports like we just talked about are not like that. You can set them up on a spreadsheet so that it's pretty automatic just to change your numbers and have it calculate. But when they're going back through this, they have to do it one-off. It's brand new to them. It takes a lot of time, and they might have to charge you $600, $700, $800, maybe several $1,000s in order to be able to come up with that kind of a report. And you have to really question if that's worth the money. So it's nice to be able to do some of these yourself. The difference in attitude still surprises me, and that is that businesses run better with management reporting because they tell an owner what they should do. You have to do some interpolation and understand financial reports and how to turn them into management reports to make them useful. But to get to your question specifically, yes, you can over-report. You can over-collect data. I'll just say that I almost never see that. Most of the time, business people have too few reports. They can't tell you basic things that are necessary in order to be able to make decisions. So it's one thing to ask a question, maybe a marketing question like, should I do some more marketing in a particular area in order to be able to do business with this certain target market? A person who sells media will say, oh yeah, we should do that. And I'll give you a whole bunch of ideas. We did a little bit of that kind of an exercise in our last program, where we came up with ideas that might help marketing. However, the way marketing should really be done is against the market. You need to really understand. You can do a better job if you understand how many are in your market, whether or not you can communicate with them. How would you communicate with them? And that requires understanding data about the market and data about your customers. I'll give you an example. One of the things I think is the most basic thing about customers is understanding who they are. That would be the standard stuff like demographics, but it also includes what they call psychographics, lifestyle numbers. How do they spend money? How are they like a certain group of people that spends money a certain way? Because we know that different beer sells in different stores. Why is that? Because different people have different tastes. And we can tell what tastes they have based on studies that have already been done, based on demographics and psychographics. And so when you have that information and you add that to the immense amount of new information that is being kept online about behavioral stuff, what that does is that helps you target your audience, your money towards your audience. Yet I would say only 10% of the people, the clients that I've ever had could pull up, say, a customer report and give me the basics like age, race, ethnicity, education level, let alone things like what kind of cars do they buy, what kind of house do they live in, what kind of income do they have, those kinds of things. We find that people who are similar in pattern have similar buying habits. So something as simple as keeping track of customers is not done. It should be done. On the industrial side, most of my clients don't even know what industries their customers are in. And so how are they going to market? How can they speak their language if they don't know? Those are simple kinds of reports that should be available to every business owner. And certainly those are not going to be prepared by the average CPA. Having said that, I've worked with 2 or 3 in my 30-year career as a consultant that do that. But that's out of hundreds. It's very unusual to find a CPA that will help you at that level.
What would you say to a small business owner that says, oh, that's only for big businesses, I don't need to do that type of reporting, mostly because it's too difficult to do, I don't have time to do it. And it's the most common reason I think I see most people say, oh, no, wait, what do we have to do? You have to get creative asking where they came from. You have to get creative of figuring a way how to track how old they are, or at least by any possible way you can figure it out, this information. Or just by making it part of your, hello, how you doing today? Where are you coming visiting us from?
Yeah.
And having a way to write down that information. So if you give advice to a restaurant on that and say, hey, you should collect that type of information, and they're like, oh, no, we're too small for that kind of stuff.
Yeah. Well, the truth is small businesses flourish because they know their customers. And if they know their customers, they should be able to go through their customers and give you that information. So it comes down to discipline. Most small businesses don't have the discipline to do it. And if they don't understand how important it is, why would they do it? That's understandable. But the real issue is, if you want to make a decision about something, why would you make a decision based on emotion versus logic? And the truth of the fact is that when you look at most successful business people, they don't make emotional decisions. They make reasonable decisions based on as many facts as they can. You'll never have enough facts to make big, tough decisions. You'll always want more information. However, you ought to have some information, and the more you have it and the more you use it, the more you realize it actually helped. So I would answer that question this way. Do you want to be one of the 90% that fail after 10 years? Or did you want to be the one that was left? I can tell you that there are only 2 kinds of ways that you're left after that. One is pure luck, and that is you got into the right niche market at the right time. You don't know what you're doing, but it worked. That's a kind of a tough way to invest money. The other one is they know exactly why they're there. They've got the information. They're learning to use the information so they can make really good decisions. Those are the ones that stay in business. Those are the ones that flourish. Those are the ones that become the millionaires most of the time.
Can I add a third category to that and tell me what you think?
Sure.
Is those that are still in business after 10 years, but the only reason they're doing it is because they're working themselves to practically the ground or get to work. They're putting the entire business on their back and potentially making a lot less than what it would be if they just had a regular job.
And I would sort of put that in the lucky category.
Okay.
Because they work really hard. I mean, the vast majority of small business people work very hard. They don't all work very smart, but they work hard. And so the issue there is that if you've created a job for yourself, which is very much true of a large percentage of people, the reason I work for myself is that I want to work for myself. I mean, getting paid when I was working, I mean, I'm retired now, but getting paid by the hour is not a way to get rich. You can do nicely, but you don't get rich. If you want to get rich, you want to sell something. You want to build a business. It has to be much bigger than yourself. A lot of people don't want to get rich, and then the other side of it is, we don't have time to talk about this. We can do this in another program. But the people who land in a crack that is open for innovation, that is not served by other people, you can actually have a lousy administrative business and do quite well because the margins are higher. And I can give you a lot of examples of businesses that were lucky. The problem is that about 19 of those went out of business for the one that managed to fall in the right crack. But that's where a lot of businesses are. They just happen to be in a protected crack, and as long as they have few competitors, they'll be fine.
Point even again, you don't mind putting that graph. I wanted to go over a couple of things and the reason why I want to bring this attention is I'm personally been trying to get this graph to work with the school that we have in Mexico, and been plugging in numbers and playing with it, and it's really easy when there was only maybe one product, but because there's so many different type of variations, it becomes a little complicated for me. We have tuition, and we have some things that we little tiny store, we have a little restaurant all built in. And so to go back to the restaurant situation, what type of categories would you recommend them to the person getting started? I guess, like, okay, just get your expenses, obviously the fixed ones, and we can go over some simple examples. But on the variable, do they go and exaggerate by saying, okay, let's get all the onions, all the lettuce, all the, or do they just say, okay, let's just make sure one category, let's throw everything in there, and then we'll start there, maybe work our way backwards. And if we want to know how much we make per burrito, then maybe we can break it down by ingredients. But if we want to know how much we're making, period, because we don't even know, what would be a good start for somebody saying, you know what, I want to change this. I might even, I don't know, figured a way how to get these reports, hired somebody or do it myself.
Yeah.
What would be a good start for somebody to get into these type of reports?
The interesting thing is that it's easier to do when you start than it is to go backwards and try and rebuild it.
Okay.
So you know, I always erred on the side of having too much detail. So in my case, I wanted to really understand, and I still do. I want to understand everything that I can think of about where the cost structure comes from. So when you're talking about fixed costs, those are all the things that you pay for, whether you've opened the door that day or not. Rent and utilities, as I've already mentioned, some people would put utilities together. So you'd have, say, power and water and gas all in one. And if it's a relatively small percentage of your overall business, that should suffice. But if you're a large restaurateur, and you're doing a lot of cooking on big grills, and you use a lot of gas, and some of them do, you might want to know what that gas is, because you can trade off between electricity and gas in some cases, or use alternatives. Maybe you'd like to know whether or not it makes sense to put in a solar panel. Well, think about the information you would need to calculate the break even on your solar panel. If you have gone into business for 5 years and you only have a single category for power or for utilities, and then you want to understand how much electricity you're going to save, do you see that that's a useless number?
Yes.
So why not put electricity in, water in, and gas? It's 3 numbers instead of 1 that goes into your financial statements every month. It's not that big a deal to keep track of.
Another question on this case, I was actually kind of struggling trying to figure it out if gas is even a fixed expense. If it's more cooking, more gas has been used, does it make a big difference on the price? Should that go on variable expense? and little things like that that I was actually trying to figure it out for a restaurant.
Yeah, well, you're right, and you do have to make some judgments there. As I mentioned, gas can go up and down based on how much gas you're using for regular heat. If you use heat to heat your restaurant, that is not part of a product really. And so if you were going to get really anal about it and you want to know what it costs you to make your product, you keep track of your space heat and your cooking heat. But I think that's going a little too far. But if you have a large plant and you're using $3,000 a month in gas, that might be worthwhile to understand that your gas bill is going up. So in days of inflation, we'll have those come back someday with all the money we're spending. In days of inflation, and I remember these well, when your expenses go up 7 to 10% every single year, you're very tuned in to how you're gonna keep your expenses in line. So if you have a power bill that goes up 10%, how are you going to figure out where you can work on that unless you have it broken down? Now you can still find that. You can go to your power company and they'll tell you. Now that's nice, but you're not going to get most of your vendors to tell you that. But if you have that by expense category, you could go back and take a look at your trend for 3 or 4 years in just a couple of minutes by opening your financial statements and taking a look at that particular expense. And then you could calculate very quickly that water hasn't gone up at all, electricity's gone up 3%, and gas, or the other way around, gas has gone up 3%, and electricity went up 25%. Well, do you see the differences in how your decision process is made? You would look at an electricity bill and you'd say, I think we better get solar right away because we could actually mitigate that and maybe save 12 percentage points on the increase. That really represents maybe reducing the cost of my burrito by 5 or 10 cents a piece. That's money in my pocket now. So as you get bigger and the expenses get bigger, it pays to have more detail so that you can do something about it. Now, if you're the kind of business person that just looks at the bottom line and you don't care about your expenses, you don't try and control anything, maybe it doesn't matter. But my experience is that those are the kind of businesses that don't survive tough times. What I want to do is show you some particulars about how this chart looks. And you can see here that this is kind of the same chart that we talked about, same kind of lines. But here's how we built them. So if you kind of ignore this here and just focus over here, we have variable expenses on this section. You can see the big ones, the cost of the merchandise here is a percentage. In this case, for set up for a restaurant, we've got the wait staff at 20%. Now this is the part that is variable because as your business goes up, you have to hire more people, and as it goes down, you're gonna have to lay a few people off. You don't have any commission to speak of. You might have an energy cost for the reasons we were talking about as a percentage if you're cooking more. No interest in this case. And so that represents the variable line over here, okay, right there. And then we go down over here to the fixed expenses. And you can see we've got salaries and benefits and cooks. These are people who you have to have a cook available, at least one, all the time, and probably more than one. And so you've got a few salaries, that's a fixed expense. You've got miscellaneous office supplies, computer, technology, insurance. Now, I would also break insurance into a payroll cost because the cost of healthcare insurance is so high now. That's one of the toughest expenses to control. So I would not both put these together in a real scenario. Maybe auto expenses, taxes and fees. Now, this is about a third of the breakdown that I'd be comfortable with. In other words, I'd like to see 2/3 more, 3 times as many expenses in here, broken into smaller components, but we're trying to keep this really simple. So, and then of course, rent. So right here, as we talked about, these are the fixed costs. And that's it, we're there. So all we have done is, because fixed costs are exactly the same every month, we've plotted that straight across, and you can see that the fixed expenses are straight across right here, 152,000, there it is, 152, and now the fixed costs just go straight across. When we take a look at the variable expenses, right here, you can see that they're going up, 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 up. Every time the sales go up, the variable expenses go up. And now this line here, all this is the total between the two. And so it's going up, but you see it's not the same slope, excuse me, it's going up, but it is this much more because the fixed expenses are included. And so now we've got our total line, and all we do is figure out where the two cross. So this is where we break even on this particular scenario, $339,000, that's right here, okay? You can see that our expenses, exactly the same as our sales level. And then what we do is we step it up. In this case, I think I added $25,000, so you had a nice slope to look at. 25,000 each column and down 25,000 each column. That creates the lines. So you can see here that here's where the profit begins. Now you can look at the profit over here. The interesting thing is that you hit break even, and then by going up just $25,000, you make $11,500. That's pretty nice. You can actually tell how much money you're going to make. And so if you go up another 25,000, you just jump to $22,500. So you're at 6%. And every time you go 25,000, you can see exactly how much more money you make. The interesting thing here is that if you were to raise your price by $1, that what you've done there is you've just lowered the relationship between your variable expenses and your fixed cost, and it changes the slope and it pops up, and you just made more money because your fixed costs stay the same. Your variable costs will potentially go up, but your fixed costs stay the same. So that's kind of how you can calculate it and where the value is on that. So having said that, this is not cash, of course. We haven't talked about cash. We've talked about the break even. So we should probably, in the time left, very briefly go through our cash flow. Okay, now back to the other screen. Cash flow. So remember on our diagram, we talked about we talked about each one of these income streams. That's cash, accounts receivable, loan proceeds, assets, and loan investment. All we do is we put that in there, start at the first of the week, then we do the same thing for the outflow. We put each one of those items that we talked about, throw it in there, and this is really simple. You put your bank balance up here, you increase it by this much, you decrease it by your total outflow, and there's your balance. And so what you end up with is this nice spread, and it shows you how the bucket balance is going to be. In this scenario, we started off with sales, similar to the restaurant. We ended up with some loan proceeds that saved us, but we continued to go down, and we ended up in a bad spot because we were closed way longer than we could afford to be closed for, and they only paid for the salaries. So that tells you when you're going to run out of cash, and how to help control your cash to a small degree, but mostly how to spend your cash. So there you go. I guess we have time for a few minutes of questions. If there's still some there.
Yeah. There's a few things that I wanted to see if you can address real quick. Was the waiters on the restaurant, you put them on variable cost. So how is it that if I hire a waiter, I'm going to be paying them a salary, probably they're going to make their tips, but am I able to calculate when I'm gonna potentially start making money from that waiter based on clients and revenue I make? Is that one kind of just jumps out of nowhere, but it's still in the variable cost?
Well, so if you're a brand new restaurant and you've got to have a waiter, you're going to have a fixed cost because you're going to pay him whether anybody's in the store. But usually as you get started and you're down the road and you got five waiters, you're going to schedule those people based on when you're busy. So if you're busy at lunch, you're going to maybe have your breakfast people come in for breakfast, lunch, and then maybe your next shift come in to lunch, dinner. A lot of people work part-time in different kinds of schedules. A lot of people like to have part-time schedules, and so you fit them in order to be able to create effectively a variable cost. Now, that doesn't mean that if there's no business, you send them home, at that moment. It does mean that after several days of doing business, and if you find that your sales are substantially less, you're going to have to cut some hours, or your cost structures are going to work. And if you're the kind of person that says, no, I've got to have 3 or 4 waiters here, and there are some big expensive restaurants that will overstaff because they expect to have really high performance. Maybe they'll have a bus boy, maybe they'll have a second backup waiter. Then in that particular case, they may say, well, we're not gonna cut back at all, and therefore we're gonna make that a fixed cost as it is. Boy, I'll tell you, it's really interesting to be able to run that scenario and take a look at changing an expense from fixed to variable and see how much difference it makes. It can make a huge amount of difference in terms of when you break even and how much money you make after that.
And then I want to, maybe next week we go more in depth on the cash flow, the tool. But I'm assuming in this case, if the PPP comes in, we very weird laws and regulations are kind of starting to come up of what's going to be forgiven and what's not. But even if it is forgiven, whatever the case might be, this will show when they potentially, even if they get forgiven, if they still have enough clientele, if they are hitting their numbers, to say at least we're going to break even in such a way where we're not going to end up going under, even when this is just like a temporary fix.
Yeah, no, that's
marketing, changing the way you do business. This could help out, figure that out by numbers, not just by like advice.
Well, yeah, I mean, you say, how can you use this? Well, you've got your rent in here, and as part of your expenses, you literally can go through and say and show this to your landlord. I can't pay my rent because literally I'm running this far behind every month, every week, and you would show rent, as a separate line item possibly, and then you go through there and just mark it to 0. It's like, I can stay in business if I don't pay rent. And of course, that's your starting point, because he's going to say, no, that's not possible. But you might say, look, I think my business is going to come back in week 10. And so I can start making money again. And what can you do for me between now and then? See, now you're kind of going. So if I were doing that, I'd say, look, you see, here's my salary. I just am dropped down to $2,000 a month. Now, I don't know how I'm going to live on that. You can see that's going to be a problem, but I have got to be able to get my expenses down, and you're charging me $2,000 a month. How about if you give me 3 months and then you show him how that can keep you in business? So, because there are a lot of variables here, and that can really make a difference in negotiation.
Big excited to see if we can get some real numbers to punch on there. It is already 3 o'clock. In respect of everyone's time, I do want to see if we could cut it, end it, but see if anybody has any questions. Let me answer 1 or 2 questions before we head out, or closing remarks. Give a few seconds, Q&A. Got everybody unmuted. Make sure. Now, David, anything? Okay. So in that case, if we have no further questions, Any closing remarks? Any words of wisdom to those restaurants in this next week of what to do with what they learned? Maybe categorizing. What would be the next step for them to begin maybe preparing to do a break even if they still need a little more help?
Well, the first thing is make sure you've got your expenses categorized in as much detail as is easy to do. Go back and have as much as a year if you can. Hopefully those are already in financial statements, are easy to find. If you don't, and if your expenses are not being watched, then at the very least, try to go back and reconstruct them and put them into fixed and variable in order to be able to get a sense for whether you can do something with them. If you're really pressed, you want to also add the categories controllable or not controllable, because there's no reason for you to spend any time on, you can't really control your utility bill. I mean, it's going to be whatever it is. You may get a rent or concession, but that's not something people are able to do much about. It's primarily about payroll. Unfortunately, that's mostly what restaurants can deal with. If they don't have the business, they don't have to buy as much food. That helps, but they really can only deal with payroll, and that's the sad part. That's exactly what PPP is here to help with. Hopefully, they've all submitted that so that they can keep those people for several more weeks. And hopefully they can get some of their other business going. But you can see that if you can't maintain a certain level of business, it may be better to actually close than to stay open, than to try and do delivery.
Harsh reality. I'm going to wrap it up then. Again, broadcasting here live from the Enterprise building. I want to go ahead and thank Alan Stanley again for letting us use his location for broadcasting this, and Michael Giants with Ron Burgess for your knowledge, and everybody that attended and anybody that watched live. We want to thank you, and hopefully this was useful. Please comment if you guys have any questions. We're going to have this video soon on YouTube. See if we can do a condensed version of it as quickly as possible, so you guys can go ahead and enjoy it without a lot of the ums and so on and so forth. Anything else you want to close it with, Ron?
No, just thank you very much for having me. It was a lot of fun.
No, thank you, and hopefully we can continue going with these and grow the audience and see if we can give people more empowering tools.
Sounds great.
Awesome.
Thanks for doing it.
Thank you.
You bet.